Hello and welcome to BQ Prime. I'm Hiral Daria. Joining us on the show today is Mr. G. Chokkalingam, founder and MD at Equinomics Research, to discuss few of the stocks that are moving and are in news today. Welcome to the show, Mr. Chokkalingam.
Good morning.
Good morning. Mr. Chokkalingam, one pack that is in focus in today's session is the auto pack. We opened with smart gains, and there is some positivity. In fact, in terms of a Bajaj Auto as well, there were news reports suggesting that plants that are oriented towards exports are going to take a production cut, taking into consideration the situation in Nigeria. Overall, what's the sense that you make in terms of auto counters and in specific a Bajaj Auto as well?
Yeah. There are four sectors which are, still maintaining growth in economy where you are seeing, the fall in the growth rates and aggregate demand slowdown. And automobile sector is one of them, particularly on the domestic front, apart from the banking sector. And then you also have still IT sector and FMCG. Maybe the volume growth is in single digit, but all these four sectors are doing pretty well in relation to other sectors. So therefore, I am quite optimistic on the auto sector, but I would suggest, within the auto sector, focus on companies which are, majorly dependent on the domestic market, like, Maruti. But however, we suggest, some of the component companies, because as against the large auto companies, there are many auto component companies which are trading at single digit PE, and I believe there is a lot of opportunity for wealth creation. Something like Uniparts, LG Balakrishna Brothers, even the large mid cap Bosch. So these are the three stocks within the auto sectors we are recommending.
Right. So that's overall with regards to the auto pack as a whole. Apart from that, there is some bit of pressure that has started to build in terms of metal names as well over the last couple of trading sessions. What do you make of the sector? Because there was a lot of chatter coming in the month of December as well that probably the metal sector as a whole could be a re-rating candidate as well. But from here on, how do you see the metal pack and what's your view?
Yeah, definitely, the metal pack will come back. But my only doubt is whether it can happen before July, August, September, of 23. Because if you look at global LME prices of aluminum, copper, and zinc, anywhere from 15 to 37% they are down from the 52-week high. So there is no visibility of steady improvement in their prices. Some few weeks they go up and then again they fall based on what is happening on the US Fed interest rate or statement from the US Fed members. So this kind of uncertainty might continue for another 3 to 6 months also. And also the worldwide, the GDP growth rate is, the revision forecast is cut across all the major economies. So that is also negative. But still, somebody wants to look at, the metal stock. There's only one stock which I would recommend is National Aluminium, NALCO, because the stock has, like other stock, it has come down more than 45% from 2-year high. And secondly, it's sitting on more than 3,000 crore of cash and a lot of capex it has deployed. And I'm pretty confident that NALCO in 6 months to 18 months time frame, it can give a decent return. Otherwise, I would suggest avoid on major metal stocks.
Right. So that's an avoid coming in with regards to overall metals as a pack, but select picks that Mr. Chokkalingam already mentioned. Moving to the next one stock from the IT pack that has been in focus is with regards to Wipro. And this is on the back of the restructuring that they have announced into 4 verticals to align with the client needs. Overall, in terms of Wipro, Mr. Chokkalingam, clearly, there has been underperformance that has come in not only from a stock price performance, but the deal wins have not really translated into revenues for the company overall. And I think in 2020 as well, the company had undergone a transformation in transition like this. Apart from that, one of the biggest acquisitions that they have made recently, that is something which is not really generate the kind of revenues it should. The stock does not seem to be excited as well with the restructuring and is down almost 0.5% in trade today and has been an underperformer as compared to peers. What's your view?
Yes, whatever you mentioned about Wipro, it's all true. It has been going through a lot of kind of stress in the business, especially from the growth perspective, no doubt about it. My point is that it is in price. The stock has come down by 37% from the peak. And historically, whenever IT managers have gone through that kind of pain, including Infosys, they came back with the vengeance. So I am not saying that it can retrace back to the 2-year high, but certainly from current level, at least 20% upside Wipro can give for few reasons. We have seen already the employee attrition is coming down in the industry. Wipro also have taken initiative to cut down the employee cost. And in December quarter, for many, the employee cost hike on year-on-year basis has moderated as compared to the September quarter. And also Wipro, it's quite due now, in my view, personal view, that the possible buyback, they have done quite some time back. So still they are sitting on a lot of cash. So the buyback also possible. Lastly, the rupee depreciation has not helped IT stock, which are primarily export oriented. Ultimately, I believe the rupee depreciation can help at least to the extent of passing on the employee cost hike to the ultimate vendors. So that is a very meaningful expectation from the employer's point of view as well. Though when the customers have become smart across the world, because of currency depreciation doesn't help, but ultimately it should help. So therefore, I would say that over 460 rupees is very much possible from Wipro from the current market price.
Right. So that's with regards to Wipro. Another IT stock, which is Mastech, that is up in trade today. And this is on the back of the strategic alliance with Netel. Now, clearly, this will help the e-commerce as well as the omni-channel retailers optimize their retail value chain. But how do you value a Mastech? Because not only Mastech, you are seeing a lot of value creation that's happening in terms of mid-cap IT counters in the last, say 30 to 45 days.
Yes. In fact, last 7-8 years, I have been propagating about the consolidation in the small and mid-cap IT. Some of my clients were lucky also, we spotted. But what I'm trying to say is that, once again, I'm quite optimistic that the consolidation involving small and mid-cap IT stocks would happen, because the whole industry is growing at a poor single digit, 4-5% in dollar term. So whereas the IT managers have got a lot of cash. And second development, after the Mindtree takeover by L&T Infotech, now there is a competition for 4th rank and 5th rank within the IT space sector in terms of the revenue base. So therefore, I believe that the consolidation would once again will get some activity. I'm not saying the stock which I'm talking will involve in a merger or acquisition, but what I'm saying, there will be 1 or 2 deals which would definitely happen that would improve the valuation of all mid-cap IT stocks across the board. So therefore, if somebody is holding Mastech, they can hold. But if somebody wants to buy, then instead of Mastech, one can buy Cyient. Personally, also I have invested. Why I recommend Cyient? Marginally cheaper than Mastech. Not only that, the major dependence on aerospace, aviation industry, which is now booming in terms of the revenue. So which would be big positive for Cyient. So therefore, I recommend Cyient within the mid-cap IT space.
Right. Moving on, Z Entertainment has seen quite a ride over the last couple of trading sessions, and now you have, NCLAT, which has granted a stay on the NCLT order with regards to the IBC proceedings, which were initiated against Z. Now, accordingly, Z is expected to move out of the IBC framework, and the corresponding surveillance actions on the company will be reverted. Further, F&O contracts with May 2023 expiry for Z also will be available for trading with effect from the 28th of February, which is today. What do you make of a Z Entertainment? Do you think the recent correction that we've seen already, the stock is at around levels of 193, should be used as an opportunity to buy?
I would suggest avoid Z Entertainment because of 2 reasons. As you rightly mentioned, it has got into a lot of issues, legal issues. So for retail investors, it is very difficult to track them on a day-to-day basis, understand. Even for us, little difficult to understand the legal issues. So I would suggest stay away. And the second reason, the competition for eyeballs is intensifying within this industry, television business. So therefore, I would suggest if somebody wants to buy instead of Z business, one can buy Sun TV because it has got successfully into sports segment. And the IPL team, many teams are valued at around 6 to 7,000 crore in the auction. Even if I assume 6,000 crore for IPL team of Sun TV, and it is sitting on free cash close to 4,000 crore, these two alone account for about 11,000 crore. whereas overall market cap is 17,000 crore. So the core television business is only 6,000 crore, which according to me is valuing the core television business only around 5-6 PE. So I believe that there will be a lot of value unlocking from DTH, OTT, and also the sports segment. So therefore, one can consider Sun TV rather than ZTV.
Right. So that's with regards to the media names. Coming to the PSU banking space, you have a Bank of Baroda that is in focus today as well. It's going to be included in the MSCI India Standard Index from today. Secondly, they have taken a decision to close the branch in UAE that they had started off last year as well. Overall, what do you make of a Bank of Baroda and from a PSU banking space? Because that has been underperforming, but a lot of people are saying that probably that's a rebound that we'll start seeing from here on.
Certainly, the recent correction one can use it to enter, and it can go anywhere around 170 rupees, Bank of Baroda. My rationale is based on the fact that the banking industry credit growth has come to 16%. It fluctuates between 15 to 17, and one need not worry even if it comes to 15, because even at 15% year-on-year credit growth would be a record high in the last 10 years. During pandemic time, it went to as low as 5%. So second, Bank of Baroda has got a net NPA of 0.99. So anything less than 1% is a really great achievement for PSU Bank. Third, so whenever the whole industry credit growth zooms, the PSU banks also come back to the growth momentum in the business. And the Bank of Baroda has done almost 21% year-on-year credit growth, which is really commendable. So therefore, I would suggest that, now the stock is trading at 0.9 times price to adjusted book value. So even if we give one time adjusted book value, it deserves about 176 rupees. So therefore, one can hold or buy with a possible target price of 176 rupees.
Right. So that's with regards to overall Bank of Baroda. Moving on, the last stock that I want to discuss with you is the Triveni Turbine. That stock has had a good run today as well. The stock is up around 5.5%. FY24 commentary has been pretty strong from the management as well. What would you advise an investor to do with the Triveni Turbine?
Yeah, I looked at it, Triveni. It has done phenomenally well and created a lot of wealth for the investors. But after the rally, it is trading at around 45 PE on current year earning. So even if I take a 2 year down the line, it is slightly stretched the valuation. So on any further rise, one can gradually sell in phases and enter stock like L&T. That would be better, which is much cheaper than Triveni. And also one more reason is that there is a meltdown in the small and mid cap space. We are not sure whether it will be over soon or it may continue for another 3 to 6 months. So therefore, from conservative point of view also, one can gradually sell on every rise Triveni Turbine and switch to L&T.
Right. So overall, these are the stocks we should be watching out for. Mr. Chokkalingam, anything other than the names that we've discussed actually catch your eye in today's session?
Yeah, one stock I would like to reiterate my firm commitment, that is Nesco. Personally, we have invested, my company also invested. I want to disclose this. I firmly believe that it's a next generation stock. This will create a lot of wealth. I may be wrong. Any analyst can go wrong, but I have been tracking this company for the last 20 years. And today it has fallen. Last 1 month it has fallen badly. I think it's a great opportunity to buy because the management of Nesco is very impressive. Last 20 years, they have been hiking the capex without borrowing. Same time, the free cash has been growing. Now it's almost around 1,000 crore. And it has got 65 to 70 acres of land on main highway in Goregaon. And now near Nesco property, the metro train is also commissioned. And third, they are increasing the capacity of IT park substantially. Now, Bombay is a place where, it's a V-shaped three sides you have a sea, and the scope for getting a free land is very limited. So I believe that with all this expansion, the stock can become in 2 to 4 years a phenomenal multi-bagger. That is my strong faith. Once again, I say that we have invested family, personal, and also in economics in Nesco stock.
Right. So that's another pick coming in from Mr. Chokkalingam as well, from a long-term perspective. Thank you, Mr. Chokkalingam, so much for joining us on the show. Always a pleasure to speak to you and get your views and insights. Thank you. Stay safe.
Thank you.